Hello, ladies and gentlemen. This is Usman Ali. I will discuss a numerical I will solve a numerical on change in estimate. That what if your asset estimations have changed after some time? So, what proper accounting must be done for that? So we will discuss that thing in our numerical. Now, the company that we have is Arcadia. HS purchased equipment worth $5,10,000, which was estimated to have a useful life of 10 years. So if I say cost of asset, so my cost of asset is $5,10,000. I just want to shift the data before I start solving it. So $5,10,000 is the cost of asset that I have. Okay. So which was estimated to have a useful life of 10 years. So the useful life is 10 years. That's estimated life, or the useful life, 10 years. Then we have with a salvage value of $10,000. So we do have salvage value. So I will write it in its own place. Salvage value at the end of that time. Now depreciation has been recorded for 7 years on a straight line basis. So 7 years back, when we purchased the equipment, it costed us $5,10,000, having a life of 10 years, and with a salvage value of $10,000 at the end of the 10th year. Now that we have recorded depreciation for 7 years, so at the end and in these 7 years we have recorded it on straight line basis. In the 8th year, which is 2005, it is determined that the total estimated life should be 15 years with a salvage value of $5,000 at the end of that time. So this is a change in estimate. We estimated that the useful life of the asset will be 10 years, but after using it for 7 years, we realized that it's not 10 years, it is 15 years actually. So out of these 15 years, 7 years are gone, and 15 minus 7, 8 years are still remaining. And after 15 years, its salvage value will not be $10,000, it will be $5,000. So life is estimated actually. Salvage value is also an estimated value, and both of the estimations changed. Now what we will do here is we will see how to record these changes and what journal entries, if needed, must be done. Okay, so let's go to the question part. What is the journal entry to correct the prior year depreciations? Now remember this thing, that if I connect this with the irregular items in our income statement, so this is an irregular item by the name of change in estimates, and for change in estimates we do not need any adjusting entry. It's just that the adjustments of change in estimates are not done retrospectively, which means we do not adjust historical data or prior year's data. We will just bring the changes and we will start applying, or we will start calculating the depreciation based on our fresh or new estimations for this year, current year, and the coming years. So for question number 1 or part number 1, that what journal entry we're gonna do to correct the prior year depreciations, there is no journal entry for that. Then our second part is calculate the depreciation expense for 2005. So let's go and let's calculate the depreciation expense. Now this solution of calculating the depreciation expense for the year 2005 will have 3 steps. The 4th step is an addition from my side, which is the journal entry. So for every step I have actually pre-prepared an empty or a blank table, and we're gonna just put in the data here. Now why I pre-prepared these tables like semi-finished tables? Because the data is easy, the procedure is easy and you can pick it very easily. That's why the tables are semi-filled and semi-unfilled. Now I shifted the data from the question that our cost of asset or the equipment was $5,10,000, salvage value is $10,000. Now what will be our depreciable base? Very simple. Think of the straight line method depreciation formula in your mind. The formula was cost of asset minus salvage value divided by useful life. So it's the same thing here. Cost of asset minus salvage value. So if I subtract it, we get $500,000, which is called as depreciable base. It means that the depreciation will be applied on $5 lakh. Then divided by useful life. That's 10 years in our example. So if I divide $500,000 by 10, it means that our depreciation expense will be $50,000 per year. It's annual depreciation expense, ladies and gentlemen. So $50,000. Now in the data it said that we recorded it on the straight line method for 7 years, and after 7 years we realized that changes must be brought. So it means that this $50,000 recordings were done for 7 years, and obviously whatever the total amount of depreciation have recorded till the end of the 7 years, what we will call that? We will call it accumulated depreciation. Accumulated depreciation means the total amount of depreciation that has occurred till today. So how much total depreciation have occurred or have been recorded in all these 7 years? Very simple. Quantity is 7 and the depreciation of per year is $50,000. So let's multiply that 50,000 with 7. We would get a value of $350,000. It means that the the purchase price or the historical cost of the asset is $5,10,000, while at the end of the second year a total of $3,50,000 depreciation is recorded. So the remaining value would be called as our remaining book value or net value. Let's calculate that. So to calculate that, I will go to my step number 2, whose objective is to calculate the remaining book value. By the way, our first objective was that what is the total amount of accumulated depreciation. So we have just calculated the total amount of accumulated depreciation to be $3,50,000. So what was the cost of asset? The cost of asset was $5,10,000. Okay. Today is the end of the 7th year. What is the total amount of depreciation that has recorded? The total amount of depreciation is called accumulated depreciation, and it is recorded as $3,50,000. So $3,50,000, we will subtract this amount from $5,10,000 and we get a remainder of $1,60,000. It means that at the end of the 7th year, according to the books of accounts, the net book value of this asset will be $1,60,000. And this $1,60,000 will be like depreciable. It will be depreciated minus the salvage for the next 8 years in order to make it 15 years in total. So let's do that also. So I will go to the step number 3, where my objective would be that what will be my depreciation expense per annum, PA, annual depreciation expense. So very simple. What is my remaining book value? My remaining book value is $1,60,000. Okay. Do I have any updated or new salvage value? Yes, I do have. The salvage value have shifted or changed from $10,000 to $5,000 now. So I'm gonna subtract this $5,000 from that book value. So $1,60,000 minus 5,000, it gives me $1,55,000. Now the total life is 15 years, as you can see here, while 7 years are gone. So 15 minus 7, how much number of years are remaining now? 8 years are still remaining. Okay, then how to calculate the annual depreciation? Very simple. We will divide this $1,55,000 by the number of years, because 1,55,000 is the depreciable base. Think of the straight line method once again in your mind. Cost of asset minus salvage value, and whatever the answer is, divide it by the useful life. So it's just the formula. Okay, if we divide it, we get a value of $19,375, ladies and gentlemen, which means that this will be our new depreciation expense for annual basis, and every year we're going to record it the same way. So if I record a depreciation expense, so what would be the entry for that? Very simple. If it is an expense actually because of depreciation, so expense increase is debit and increase in expense is debited. So what we will do is we will debit it by $19,375. While what would be credited, you know it from your basic understanding of depreciation, that accumulated depreciation account will be actually credited. And how much amount will be credited? The accumulated depreciation credit would be exactly the same which you have done for the depreciation expense. So this would be our entry. Our objective, once again, if I summarize the numerical, was to calculate that what will be my updated depreciation expense. I have been using an old estimation of 10,000 and 10 years in my mind with the cost of asset of 5 lakh and 10. So my objective was actually to calculate that after these estimate changes, what will be my annual depreciation, the fresh one. In order to know that, we should first know that what will be the remaining book value at the time of this change has occurred. To calculate that remaining book value, we have to go through these first two steps actually. In the first step, I have calculated the accumulated depreciation. You know the process, we did it here. And then we came to our ultimate objective of knowing the remaining book value. So we realized that at the end of the 7th year, when the changes has occurred, the remaining book value in our books of account is $1,60,000. So this new estimations is applicable on 1,60,000. What is gone is gone. As earlier I said, that change in estimate irregular items are not adjusted retrospectively, means for prior periods we do not do any adjustments. We just need to take care of coming time only. So 1,60,000 represents the coming time, and based on 1,60,000 we calculated that okay, then our annual depreciation would be $19,375. So this was the concept of change in estimate. I hope you got it. Thank you very much, ladies and gentlemen. Stay safe.